In this short video, we will consider some of the rules that regulate the process of a business taking out insurance. Broadly speaking, there are two main types of insurance. Life insurance is a type of insurance where the insurer agrees to pay an agreed sum upon the insured's death or the attainment of a particular age. General insurance includes property insurance, where the insured is indemnified upon the occurrence of a loss of or damage to particular real or personal property. Liability insurance, where the insured is indemnified in the event of a claim against them by a third party. And motor vehicle insurance. So, for example, if a business wants to avoid the potential cost associated with providing careless advice to a customer, it might take out professional indemnity insurance. If a business wants to avoid the potential cost associated with a member of the public becoming injured when they are visiting the business on its premises, then it might take out public liability insurance. One of the most important legal concepts associated with a contract of insurance is the notion that a contract of insurance is a contract uberrime fide. This means that it is a contract of utmost good faith. Both parties to the insurance contract, both the insurer and the insured, have a duty to disclose all material facts to the other party. The insurer must notify the insured in writing, before the contract is entered into, of the consequences of breaching the duty of disclosure. And the insured person has a legal obligation to provide all relevant information to the insurer. If the insured becomes aware of a change in circumstances that increases the risk, then they have an obligation to notify the insurer of those changes. The consequences of failing to comply with the duty of disclosure depend upon whether the failure was innocent or fraudulent. If the failure by the insured person to provide all relevant and correct information to the insurance company was fraudulent, in other words, it was deliberate, then the insurer is entitled to avoid the contract. And if the insured person has made a claim, then the insurance company is entitled to refuse to pay that claim. However, if the insured's failure to provide all relevant and correct information was innocent, in other words, it was accidental, or the insured person simply was not aware of their obligation, then the liability of the insurer to pay a claim is reduced to an amount that would place the insurer in the same position it would have been in had the failure to disclose not occurred. This means that if the insured person had told the insurance company everything that the insurance company needed to know, and the insurance company would have responded to that by increasing the amount of premiums payable by the insured person, then any claim made by the insured person will be reduced by the difference between the premiums. And if the insurance company can successfully establish that if it had known the truth it would not have granted the insurance at all, then in those circumstances the insurance company is entitled to refuse to pay the claim. There are three important legal concepts associated with insurance contracts that we'll explore in the remainder of this video. The first is the notion of the excess clause. An excess clause is a clause in a contract that provides that the insured will be obliged to pay the first part of a claim themselves. In other words, in order to reduce the amount of premiums payable, the insured person agrees that if the amount of loss that they have suffered is below the excess amount, then they will not make an insurance claim and will instead bear the cost themselves. And if the amount of the loss is greater than the excess amount, then they will pay the excess amount themselves and only claim from the insurance company any amount in excess of this amount. This is why the insurance company is prepared to charge a lower premium. The second legal concept relates to overinsurance. This is where the insured person insures the property for more than its true value. In those circumstances, the insured person is not entitled to receive more than the insured value as compensation. Most insurance contracts are indemnity contracts, which means the insured person is only entitled to receive the actual amount of their loss. There is therefore little or no benefit to overinsuring. But what about underinsuring? This is where the insured person, perhaps with the intention of reducing the amount of premiums that they're going to have to pay, tells the insurance company that the insured property is worth less than its actual value. Most insurance contracts will contain an average clause. An average clause is a clause in the insurance contract that clearly states that if the property is underinsured, then the amount of any claim made by the insured person is reduced proportionately. So if the insured person has taken out insurance over a particular item of property and has told the insurance company that it is only worth half of its actual value, then when the insured person makes a claim, they will only receive half the amount of the claim. The final legal concept is that of subrogation. In most indemnity insurance contracts, the insurer is granted a right of subrogation. Upon payment of the claim, the insurer assumes all of the insured person's rights in relation to the subject matter of the insurance, including the right to sue a third party if they are the cause of the loss. So, for example, if the insured person is taking out car insurance and they are involved in an accident that is caused by the carelessness of the other driver, then the insured person, instead of suing the other driver, is entitled to make a claim on their own insurance. But when they do so, their legal rights are subrogated to their insurance company. Their insurance company becomes entitled to sue the other driver as if they were the insured person, and that way the insurance company can recover from the other driver the actual amount of money that they had to pay to the insured person.